Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. In today's episode, Anthony Power and I are pleased to welcome Jason Les to the program. He's the CEO of Riot Platforms, and they just came out with their Q3 earnings. We're going to be talking about this in addition to strategy and outlook during today's episode. Before we get into it, take a second, smash the like button, guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comments section below if you're currently holding shares of Riot and what you thought about their earnings. With that being said, let's get into today's podcast. All right, guys, away we go. That's right. Today's podcast, Q3 earnings. We've got Jason Les, CEO, back on the platform. This is an exciting one. We listened to the call. We went through the earnings presentation. A lot of questions, a lot of excitement right now at Riot. Jason, thanks so much for joining us. Looking forward to the discussion.
Thank you for having me, guys. Looking forward to diving into it with you.
Yeah, this will be great. We covered preliminary results and some of our favorite slides on today's earlier episode. We're going to dig into more of that as we go through tonight's podcast. The first question, can you talk to us about some of the highlights, in your opinion, from this most recent Q3 period?
Yeah, I think there's two major themes for our earnings release for this quarter. One, the improved financial operational results of the company. That's one half of the story. And of course, the other half of the story is how quickly we're advancing on our data center strategy, which I know we're going to talk more about later. But from the quarterly results standpoint, we had record revenue of about $180 million. We had net income of $104 million. And I think this is driven a lot by our operational improvements, some of the hash rate growth we have, but also our operations really strengthening over time. And that's both from the Bitcoin mining side and the engineering side. We highlighted in our earnings release, the engineering segment, record gross profit as well. They are doing an excellent job. And then our Bitcoin mining business, our hash rate's been going up. We've been having strong utilization, and we really had a strong summer on the power strategy as well. With that, we got an all-in power cost of the third quarter of 3.2 cents, resulting in a direct cost for Bitcoin of about $46,300. So very good results there. We're very happy about what we've been able to show from a financial results standpoint. The core business is strong, and now we are undergoing a transformation, building out the data center future for Riot as well.
Yeah, I looked at the results this morning in UK time, and on sort of on first view, it's they are improved from previous quarters. I still find great margins on engineering and great margins on mining as well, but I still find the challenges in mining going forward is when you look at covering all the costs, and it's not just about electricity. You're covering the depreciation costs, the cost of those machines, which I think it's fairly important. If you're going to buy them, you've got to show the cost somewhere. It's not just for you guys. You guys have done magnificently well on getting that power cost down 3.2 cents. That's going to be probably one of the lowest we'll see across the board when all the earnings are released. We've only had yours and Core Scientific up to now. But I still feel going forward into this next couple of years, it's the challenges of, with the difficulty going up. I mean, how are you guys, when you sit around and look at the mining and look at the difficulty? I think the last 9 changes, I think 7 of the 9 changes have been an increase in difficulty, which means your production is being sort of eroded effectively. And does that sort of then start you focusing really that strategy towards using that power for the best return? Let's get moving on that and see if we can get that implemented, as quickly as possible to sort of get those better returns in place.
The reality of the economics that data centers drives is pushing us towards that kind of no matter what. What Bitcoin does, or what Bitcoin mining economics do, what hash price does, doesn't really impact our decision making anymore. We see the value creation opportunity with data centers. We see what the market is attributed to this, the types of valuations that you can get from this, and this is what we're moving forward on. So I think we are in a great spot with the business that we have today. As you highlighted, Anthony, we consistently show strong Bitcoin minings. strong Bitcoin mining margins. I attribute that to our efficient operations, our very low power costs, and that will continue to be a strong core part of the business that churns out cash flow as we undergo our transformation, as we build out the data center business. So the two things work complementary, and the Bitcoin mining really helps us on our path towards building out and ultimately leasing data centers.
In terms of Rockdale, because we know you're sort of like your 400 megawatts at Corsicana is being fully utilized now and delivering good results. And let's be honest, this year, 2025, has been a great year in terms of monthly production, because at the moment you're topping my year-to-date charts, which in the last 4 or 5 years you've never been that
Proud to
high
be
in the
there.
table. So you are, and yes, we've got some miners not releasing their monthly updates, but to be honest with you, you're beating some of the big peer miners out there like CleanSpark, Hive Digital. Normally are up in that first or second slot. You're beating them, and if you can beat Hive Digital on a year-to-date basis, you can't be doing too many things bad. So 400 megawatts at Corsicana, but you've got no tenants at Rockdale, and Rockdale appears to be, a future view of HPC once Corsicana is sort of probably more and more up and running. Is there a plan to sort of like increase things at Rockdale in this sort of period to give you more cash flow to help pay for some of the strategy going forward? Or do you feel that what you've got at Rockdale now is sufficient and you don't need to add cost, or you don't see sufficient margins coming through in this next, say, 2 to 3 years?
Well, what I want investors to know is that Rockdale is absolutely a part of our data center story. At the end of the day, our objective is to maximize the value of all of our megawatts, and to do that, we are, building out a data center business, and we'll aim to look to build at Rockdale as well, and ultimately sign leases. Some impediments to that we recognize and we're working diligently to overcome, and I feel very confident about that. And that's why on our earnings call yesterday, I made it clear I wouldn't want investors to count Rockdale out of our story. And I wouldn't think of the development pipeline as strictly consecutive. There will ideally ultimately be some overlap here. So, ideally, eventually we're developing Rockdale alongside Corsicana. But in the interim, Bitcoin mining is a very valuable tool to secure and make use of the megawatts that we have there. We don't want to strand power. We don't want to have unproductive megawatts. So we do have, Bitcoin mining remaining at Rockdale. We have some growth of hash rate planned at Rockdale, and that is going to continue churning out good cash flow for us while we undergo this transformation.
Yeah, I phrased that question because one of the questions came across about HPC at Rockdale, and you said it was more the focus on the Corsicana. Yes, we will get to Rockdale. And then in a previous podcast, we talked about that cash flow from mining to help fund the sort of like the strategy of HPC, because all companies who are talking about HPC, you're not talking now, you're talking 18 months, 2 years from now, because it's going to take that long to get power, to get buildings, to get all the contracts in place before you start even receiving revenue. So you might as well get as much cash flow coming in from that strategy that is enabled at the moment, which is the mining strategy, obviously.
It all comes down to the strategy of monetizing and maximizing the value of the megawatts we have. And I wouldn't just think about it as like, just Rockdale. It's, we have Bitcoin mining operations at Corsicana as well. So wherever we have Bitcoin mining, we're using that as a tool to make use of the power that we have and turn out, cash flow for the company. We have a robust, very large Bitcoin mining business now that's turning out, hundreds of millions of dollars on an annual basis. That gives us an internal source of financing for growing our data center business. That's very valuable. We're leveraging our operational efficiencies and advantages to bring in cash flow to fund data center growth. And that's a great position to be. So we're using that tool at both sites. And then ultimately, the goal is to fully build those out for data centers when the time is right in the strategy.
Hey, now speaking of development, there was some awesome images and renditions of the Corsicana site in this deck. I really liked what we're seeing there, the new design, the new renderings. Can you talk to us about the decision to move forward with this core and shell structure? construction. We generally understand the shell of a building. You can put as many pieces in place in advance as possible. What do you mean by the core build out, and what does this enable future co-location contracts to look like?
So the first thing I would say is this announcement is just one milestone in our development pipeline that we're announcing right now. I think what this announcement reflects is our confidence based on what we're seeing in the market, our confidence in our ability to lease, and our confidence in our team to deliver. So we don't feel like we need to wait in order to get development started. We want to make sure we're delivering data center capacity as rapidly as possible and that we're getting to data center revenue as quickly as we possibly can. This is also a part of positioning us, putting us in the best position possible to lease with the widest array of highest quality tenants possible. When we say core and shell, a common industry term for data centers, what we're actually building is a little beyond that. We actually call it core and shell plus, but for the sake of just sticking to terms that are well known, we call it core and shell in the earnings deck. And so we're building even a little bit beyond what a typical core and shell is. We are, building out the watertight building structure. We are building the generator buildings. We are completely finishing the administrative function parts of the building, security, fire protection, starting on power distribution, mechanical, loading. We are doing as much as you possibly can before the data hall fit out. And we're doing this in order to accelerate our timelines and be in a position to turn that core and shell into a build-to-suit Tier 3 data center as rapidly as possible after that point. We've talked about our basis of design. That was a big milestone that we accomplished this quarter. And we are building something that has flexibility to ultimately be adaptable to what the final tenant specifications are. So we're going out, we're hitting the ground running. We have a lot of confidence in our ability to deliver here. So we're starting with these first two buildings, and as we progress on our strategy, you can expect us to provide updates on additional milestones in the full pipeline.
Yeah, there's so much more in this presentation for this earnings than what we saw in the previous one, and it's sort of like answering a lot of those questions now. One question I raised, and it wasn't raised last night on the earnings call, was the sort of like the phase one, looking at the size of these buildings and the compute power supporting them. And I'm a numbers person, so I always play around with numbers. And I noticed the size of these as 56 megawatts, and in my head I'm like, well, we've got TeraWulf and we've got Cypher operating with Fluid Stack, and they're 168. 356 and 168. There's no such thing as coincidence, but is there a case of like standardization in terms of building these? Because we have seen other peer miners go for slightly less than 56. So I was just like putting that question out there. Quash that rumor, please, and put us right on its standardization.
Yeah, what our building design represents is it's really a multiple of 14. Our standard design is 14 megawatt data halls, 14 megawatt data halls per building, 56 megawatts per building. We're talking a critical IT load, of course, and then we have multiple buildings, and we can do multiple stories from there. That is ultimately something that can still be kind of changed around. Like I said, there's adaptability in this design still, but it kind of reflects the general area of I would call it data hall size multiples that you should expect a wide array of customers to be looking for. And that is really, I want to emphasize our strategy is to bring forward a design and to bring forward a sales process that can accommodate the widest array of high quality tenants possible. That includes neoclouds, that includes enterprise customers, that includes hyperscale customers as well. We are positioning ourselves and using what our team knows, the data center team that we've built up of incredible talent over the past several months, using their experience going through this process to position Riot to have to be able to serve the widest array of customers and ultimately get us the highest value possible out of the assets that we have. And we've gotten a lot of good feedback about the assets that we have, our sites, Corsicana, Rockdale, etc. And so we feel very good about progressing with our strategy, and that's why we announced the two initial developments yesterday. And I want to clarify, we announced 112 megawatts of core and shell development. That doesn't mean that we're just trying to lease 112 megawatts. That is just what we have started building right now without a lease in hand. Obviously, as we get more into the sales process, ultimately we're going to find out what that first anchor customer is looking for, the first anchor tenant at the site, and then ultimately what we develop is going to be a function of what they're looking for.
Do you feel? I mean, we've noticed peers like Core Scientific and TeraWulf have delivered smaller scale HPC to then prove to the market they can deliver it. Is that something that's crossed your mind in terms of how you could attract a wider range of customers, be it the largest to the smallest, or do you feel actually with the people that you brought into the company, you have sufficient talent to develop these data centers and run these data centers as they should be in a co-location deal?
Yeah, I think it's more important how we are structured and how we are put together and how we present ourselves than it is if we have signed like any deal, data center deal in a binary sense. You look at these hyperscalers and they are investing in substantial amounts of CapEx. And I'm sure you've seen quotes from earnings calls and interviews this week. They consistently are raising their CapEx budgets and they are consistently making comments that their capacity needs outstripped what their prior, aggressive assumptions were. So these hyperscale customers and enterprises and neoclouds are going after capacity very aggressively. All the same, hyperscalers are still large organizations that are very meticulous about their process. They are very cautious about what they're committing so much capital to. You remember, if we're building a build-to-suit data center at, let's say, use industry averages of $10 to $13 million per critical IT load, the customer is spending twice that amount on GPUs. They're making the bigger CapEx investment here, and that's why they're really looking to de-risk the process. And we think what we know from our team's experience is we de-risk the process for them, and we present the best by taking the steps we've had, completing our basis of design, where we've been now having technical outreach with customers validating our design, where we position ourselves for success by initiating a development. So we're not just talking about power conceptually. We demonstrate our confidence and we show that we are building forward and we have something tangible to have a leasing discussion around. And we have a team that's familiar with the vendor onboarding process that these hyperscalers present. So it's not so much about signing a deal with anyone to demonstrate credibility to the market. It's about how we structure and how we position ourselves to these customers.
Hey, one more on the team that you guys have assembled. The slide did a great job of showing some of the senior positions you've hired. Last time we chatted in person, Jason, you had mentioned Riot as an organization is really looking to develop these data centers, build these projects in-house, as opposed to maybe partnering with another data center firm and giving up some of the economics. So two-parter for you. Do you now feel you have that team in place to execute on this type of plan? And based on these hires, do you have the ability in-house to operate as a CSP or run GPUs yourself if you wanted to do that down the road?
So our hiring strategy has been to build out a team in order to be able to meet the expectations of creditworthy counterparties in the market, being able to deliver build-to-suit data centers ourselves. We did this because we saw this as the way to maximize the value of our assets by being able to retain all of the economics to Riot. I'm not opposed to doing, a type of JV in the future. I think there's potential structures that could work, but the best path forward for Riot to get started is for Riot to be in control of our process, in control of our own destiny, and then retaining the economics. that gives the most upside to our shareholders. On the earnings call yesterday, I likened our hiring strategy to a pendulum. We are hiring based on what we need at that point in our roadmap. Over the past quarter, the focus has been design and engineering. So you see there as we've hired a lot of leadership in design and engineering. Now that pendulum will start swinging to the sales and leasing side. And very, very recently, we included in our deck, we hired a senior vice president of AI and hyperscale sales. So that sales area is the focus of hiring right now, and then that's going to swing into operations hires as well as we progress down the roadmap. So we feel great about the team that we've developed. Obviously, the fact that we are starting this development, I think, demonstrates to the market that we have the team necessary to execute on developments of building build-to-suit data centers. Your question, Bryce, though, was about specifically deploying GPUs and being the cloud service provider. Look, we're open to any idea that is going to maximize the value of the power that we have. Obviously, we're aware of the attention and opportunity there, and that's something that we are looking at and educating ourselves on and getting smarter at. But we see the near-term opportunity for Riot to best maximize value is to focus on this co-location strategy, focus on development, and focus on leasing. We want to get a strong anchor tenant into Corsicana to start that site off, and that is the foundation that we can build the rest of our data center business on top of.
Now, it came up on the call last night, Jason, that where your sites, Rockdale and Corsicana, are situated, actually provide some of the best locations in Texas for HPC co-location deals. And that's because you're very close to Dallas and also to Austin. I know you're not going to turn around and say there's a client on board, but would you say that over the last, say, 4 months since we last spoke at last earnings, that you've had sort of like the communication has ramped up? Because we're hearing obviously in the news that there's a massive shortage, power is key, and the miners have got power. Or are you saying it's been fairly consistent, but we're having conversations, with lots and lots of different people. But in this sort of like incessant now, we want to get, the gigawatts towards HPC, and at the moment we're nowhere near where the demand requires it. Would you say that there's a run up to in terms of plenty of opportunities out there that you see, hence why you've actually gone so much further than the last time we spoke and the last presentation you had in terms of where you're going to deliver this strategy at Corsicana and then at Rockdale?
Compute is incredibly constrained. The power to supply compute is incredibly constrained. And you don't have to take my word for it. One of the best research analysts in the space, Stephen Bird from Morgan Stanley, he covers AI technology thematically, and he has a report he puts out on the estimated power shortfall. And every quarter, every time he puts out this report, the shortfall increases. It most recently just increased from 45 to 49 gigawatts. And that's over the next few years. So based on what he sees in the market for compute demand, the power required to support that, the industry is short 49 gigawatts. So we're in a tremendous opportunity because of that. And, I'll add to say, our other peers who are similarly positioned are also in a great opportunity. We all are sitting on something, very valuable, access to power. And, he talks about that in his report, actually, the Bitcoin miners, they can do, actually, Bitcoin miners alone, of course, cannot solve that problem. There's not 49 gigawatts of Bitcoin mining facilities in the United States, but they go away towards helping solve that problem. I think we are particularly well positioned because, as you noted, Anthony, our site's an hour outside of Dallas, one of the biggest data center markets in the country, and Rockdale, an hour outside of Austin, a growing data center market, a huge technology hub. Being near these major metropolitans is a big advantage. And it's not just about, being close to fiber. Of course, that's important, but it's also about being close to business and people, the people that will be needed to operate that data center, and being close to the different zones that the customers need capacity around. So the constraint is very real. And, we were on this road already. We are on this path to building out our data center business. The feedback that we've gotten on our sites and the confidence that we have in ourselves to build and deliver here has led to us starting these developments. Like I said, without a lease in hand, just looking to aggressively build and position ourselves to take advantage of the constraint and the opportunity here.
Great. Hey, I have two on the topic of power for you, Jason. So one is to do with PPAs. This is something Anthony and I were discussing the other day. It sounds like most of the traditional Bitcoin miners are kind of looking at this as their last cycle in terms of large scale mining. They're transitioning to HPC. You guys are in a unique position. You have these PPA agreements, as you alluded to. You're able to really monetize those for the business in a big way. I believe they're kind of tiered in terms of how they come off, but can you talk to us about how long those PPAs run for, what the plan is post PPAs? We understand HPC AI, a lot of times the power will be a pass-through cost, and how that kind of lines up nicely with this Bitcoin cycle here.
Yeah, so we have a variety of different, we refer to them as hedges. They're financial instruments that we procured. Our agreements to supply power are not at risk. They don't expire in 2027 or 2030. It's just we have purchased hedges at a fixed price power 24/7, 365. Most of those run through 2030. We do have some hedges that run through 2027 as well. As those fall off, first on if we're talking about supplying power for Bitcoin mining, we take the market price. We've been largely taking the market price at Corsicana. We don't have we have some hedges at Corsicana. Most of that power is unhedged, and we've still been able to achieve a very competitive cost of power by doing what we do, participating in 4CP, participating in ancillary services, and just shutting off during high-priced hours. That alone is going to get you a low cost of power as a Bitcoin miner. Of course, that's not possible as a data center. You need, full uptime. Um, Data center tenants are not as discerning on power cost as Bitcoin miners are. You guys would not love it if Riot entered into a long-term power hedge, getting power at for example, $65 a megawatt hour. You'd say, hey, no way for Bitcoin mining. That is way too expensive. But for data centers, that kind of still fits the range of what customers are talking about. So ultimately, what would happen is, to the extent that hedges are needed to support data center tenants, either we or they would be entering into power hedges around that range. It depends on what the market is at the time to fix that price of power. So it's a relatively simple solution. What's great about operating in Texas is these hedges are market driven. I could pick up the phone right now and start securing hedges if I needed to. There's not an approval process. You're not working with a utility or government or anything like that. We have a ton of experience doing this. Riot has built an incredible capability in securing and managing and trading power. So we bring those capabilities to our tenants. When they need power, we will lock up the volume of power that they need.
Yeah, great answer, and a real competitive advantage, I think. And we talk about ESS Metron as another one we'll get into next. The second power question, though, I had for you, talk about upgrading the substation at Corsicana. We were under the impression, obviously, it's energized. Can you talk to us a little bit about what that entails, and are there differences in terms of how the substation looks for HPC AI versus Bitcoin mining, or just general kind of context there?
So what we're doing at Corsicana right now is expanding the substation. We have the first 400 megawatt substation already energized, and now we are in the process of expanding that to 1 gigawatt. A process we already had underway, but start actually a year ago now is when approximately is when we started this process. So we've already received the transformer, the next 400 megawatt transformer for that expansion. So that site will be up to 800 megawatts in the first quarter of 2026. And then we're on track to get to 1 gigawatt by the end of the year. So we are energizing our additional substation capacity well ahead of any potential data center use. We're on track there. And another way that Riot has de-risked its expansion and development. And I'll tell you, the fact that we are able to show a site that has a large volume of power already live goes a very long way to proving the validity of power at our site. It really shows a de-risk path for that customer, shows that we've crossed the hurdles that you need to bring power in.
Yeah, I've been to the largest data center in Europe, and that's the Meta data center in Sweden, and that's 150 megawatts. So I'm looking forward to getting this vision at Corsicana when you start delivering the size of data centers there, which will sort of like blow that Sweden one out the ground. In terms of the piece of land that you bought, which you're going to develop, I'm assuming you're going to have to get that lorry back in place to sort of like start moving a lot of the ground there in readiness to develop that site. Is this going to be like a similar task to what you developed already at Corsicana for the mining space?
The mining space was a lot more of a challenge. That
Oh,
original
right.
plot of land was a lot more challenging than this one. This 67 acres of parcels that we acquired across the street, this is the best possible piece of land that we could add on to our site to grow into. We already have the other land that's nearby. We could build on into that as well. Would have some additional complexities, but to get a piece of land directly across the street, contiguous with our site already, really de-risk the development for us. That land is in good condition. It's relatively flat. There's not as much that we need to do. But you're absolutely right, Anthony. We're starting with the first two buildings of our data center development on our existing site, where we already have the pad laid out. And then we're going to start working on that land across the street so the subsequent buildings can follow from there. So what we'll do is we have 112 megawatts, beginning development on the existing plot of development pad. We go across the street. That'll take us to 504 megawatts when that is all fully developed as well. And then, eventually, as the pace of lease signing is going, then we would take down our Bitcoin mining buildings in the future and then build the final capacity there and taking that site up to 672 megawatts of critical IT load, 1 gigawatt utility load power, fully utilizing the site.
In terms of PUE or the basis of ancillary power to compute power, what are you coming up with at the Corsicana site as a
So
guide?
those numbers right there pencil out to approximately a 1.49 PUE. And if you look at some of our
Yeah,
peers who have done deals in Texas,
exactly the
that's
same.
about the range they've in as
Exactly the
well.
same.
As you know, that PUE is your worst case PUE. You have
Yeah.
to build out for the hottest, worst day of the year. Of course, that won't be the PUE all the time. I'll also add that is our base case. That's our starting point, 1.49. Of course, we want to do better than that. So now we have set a base case, and the challenge is on us to improve that PUE from there because that just is better economics for us.
Here's a question for you, Jason. It's just this one's just really come up, so I really apologise for that. But in terms of when Corsicana is fully developed for HPC in the future, and you've just said something that was interesting. You said we might not use all the power all the time. Um, I know that Fred Thiel at Mara's looking to sort of like utilize data center power when it's not being utilized for things like Bitcoin mining. Is that something that's sort of like in your mindset as well, actually? Why stop the Bitcoin mining if we can still utilize that when the data centers aren't fully using the power that they've got? Is that something that's even you thought about?
Absolutely. That is a huge strategic advantage. You don't want to have wasted power. You're going to be paying for that power anyways.
Yeah.
That's just, a cost. So we can be more competitive by using a flexible load like Bitcoin mining to leverage that unused power. So I think you can probably expect us to have some amount of Bitcoin mining always there in order
Oh,
to fill
yeah.
that. We talked about that additional land that we have at Corsicana. So even as we followed that development, that campus plan, and built phase one and phase two, which would take down the existing buildings, what we would still do is just build some Bitcoin mining capacity elsewhere, probably on the other land that we have, to fill that load balancing capacity and get that advantage. I think, Bitcoin mining is still a new and interesting thing. Obviously, that's not a tool that normal data center companies are using. And the fact that companies like Riot have experience doing that already, it means we're in a great position to kind of be ahead of the curve of utilizing that and driving a more competitive outcome.
Good question. Better answer. And I think there's probably a lot of happy farmers around there selling all their land to these data center companies. I'm sure it's good for property values, but that's great. And yeah, you talk about the proximity there. Then you guys have that large, I think it's 593 acres as well, that, like you said, a close but not touching the Corsicana site. I wanted to touch on engineering. We asked some questions about this in the last earnings. It seems the sales funnel, the backlog just continues to grow. You guys, again, a unique advantage of Riot. You went out and purchased ESS Metron kind of with foresight, I guess, of what was coming. This obviously helps you internally, but you're actually able to generate revenue to external sales as well.
Yeah, and we included, a quote that I think validates our strategy there in our earnings deck. It was from a UBS Global Research report that highlighted how some of the biggest components in short supply for data center development are low and medium voltage switchgear. That is exactly what Metron specializes in and manufactures. And that is also the same type of gear that the service side of our engineering segment, E4E Solutions, they help service as well. So we really de-risk our development by having this visibility and control over our supply chain. The other benefit that we get that we highlighted in our earnings deck is the CapEx savings over time. You guys, if we're buying ourselves, the money is just all going, from one pocket to the other anyways. So we get a CapEx strategic advantage, and then we get the supply chain advantage as well. And then on its own, this is a flourishing business. We are doing all the business that our manufacturing capacity can do. So we're maxed out on capacity there. And one of the reasons that you see the backlog growing and then you see the results in that segment growing is we're getting so much demand and so many more high margin contracts out there. Riot is a minority part of ESS Metron's business. Major 90% of ESS Metron's business right now are other data center customers. So, there's Riot, minority portion, and then everything else they're doing, supplying data centers, all over the country. So, we're very encouraged about that. Obviously, that motivates us to, continue to scale ESS Metron and do what we can in order to service that backlog. But we expect that backlog to continue to be healthy as more demand comes in, and Riot sits in the advantageous position of not being in the backlog of another producer, but having the capabilities all in-house to produce what we need.
In terms of SG&A, which is obviously a subject close to my heart, being a chartered management accountant for the last 30 plus years, cost is key. Now, in your presentation, you talked about the reduction, certainly by percentage of SG&A over these coming sort of like 18 months as you grow. And you've also indicated that in regards to, I think it's the stock compensation figure, that's going to start reducing from Q3 next year. In terms of this thought process, can you just talk us through why that's occurred? Is that because there's looking at other alternatives to reward staff, or is it a case of that you're seeing the industry as such, like growing stock compensation in a sort of like a hamster wheel sort of effect, whereas one miner starts issuing, the next miner thinks, well, we need to get on board with what they're doing, and it seems to like go in a cycle. Everyone seems to be one-upping everybody else, and for me, it's like, I agree the principles of it is right. We'll reward staff, make sure their goals are focused, but it's about proportion to sort of like revenues, and shareholders are probably going to start like getting concerned. So what's the feeling towards why you've reduced it for next year?
So, the first thing that I want to highlight is the improvements that we're demonstrating in SG&A and the operating leverage that we're demonstrating. Our revenue in this quarter, Q3 2025, compared to Q3 2024, is up 200%. I mean, it's over double. So, up 100%. It's over double what our revenue was in Q3 2024. At the same time, our SG&A is slightly down in Q3 2025 compared to Q3 2024. And you basically see that reflected on the graph there, where SG&A, including non-cash stock-based compensation, was 79% in Q3 24 and is down to 38% in Q3 2025. What we wanted to highlight is the big portion of our stock-based compensation expense is a prior award that was made at the beginning of 2024 and has been expensed quarter over quarter. We haven't been giving out, a ton of new awards all the time. In fact, myself and the senior executive team have not received any equity awards this year, and we won't. What's happening is what we're showing is that prior award is the biggest chunk of our quarterly stock-based compensation expense. It's about $25 million a quarter right now.
Yeah.
And in Q3 2026, it will fall to $8 million. And then after that, it'll be eliminated entirely. That's
Right.
not saying that stock-based compensation will be eliminated entirely. There's other grants and awards that are in there. And, of course, there'll be awards at some point in the future. But that single 2024 grant that we're talking about, that takes up a bulk of the awards. That is on a flat expense schedule, and then that is going to fall off one way or the other.
So these quarterly ones that we've been seeing now for the last few quarters are really sort of like paying back what was issued in 2024 then in terms of the stock compensation, in terms of shares issued there.
Yeah, I mean that's how stock-based compensation is expense. You look at the grant date fair value, you make an assessment of the probability of earning the award, and that's essentially approximately straight lined over the entire vesting period, and then it falls off. So when you make the grants, it's not like you take all that expense up front and then it's gone. It's expensed over the vesting period of the award. And so this is, just to summarize, there have not been new awards for our senior executive team that have been being made. This is a prior award from the beginning of 2024. Its expense schedule rolls off in Q3 2026 pretty significantly and then falls off from there. And so, you could read into that means that our overall stock-based compensation is going down because that's a big part of it.
Yeah, thank you. I had another question, but you've answered the question, and it saves me asking the one that was not related to it now. But no, thanks for being very clear. Now we like to have that little segment as part of the interview there, because otherwise we just skated over certain things. The other thing that I saw in the actual update, which was obviously you've now sold out all your shares in Bitfarms. Obviously that 90 million shares that was purchased initially, they've all been sold now. Was it a straightforward decision to sell the shares? I mean, I know the Bitfarm share price since then has really done well, but I mean, I suppose opportunity at the time to use that money, even though it was less than what you paid for them. Do you feel that you've been able to do something more positive with that money and make the wheels go around quicker, or is it just the luck of the draw that you've sold and the share price has rallied?
Yeah, the share price has certainly gone up a bunch since then. Listen, we have.
It proves you were right, Jason. It proves you were a good company. You should have stuck with.
We have big growth that we have underway ourselves. There's a lot of CapEx that goes into our growth. So, we have to look at the sources that we have to fund that growth. We could, and at the time, we're making calculation looking at, we have cash on our balance sheet. We could use the ATM. We could sell Bitcoin. We have Bitfarm shares that we could sell as well. So, as we're making our capital allocation decisions, we're using the best tools at our disposal in order to finance those. And, for us, that was selling Bitfarm shares earlier in the year.
Does that sort of situation put you off of any future M&A activity? And I suppose what I'm leaning to is the fact that we're already identifying. You've just identified the report that's been produced on a quarterly basis to highlight that shortfall in power. We've just noticed one of your peer miners, CleanSpark, decide to 180-degree turn around their pure play strategy into a HPC strategy now, and they've picked up a piece of land in Texas. which, in your neck of the woods, and it's like, how much power is available? I was assuming there was such a shortfall. Everyone's looking at every piece of land. We know that the miners have got the land. There are other miners out there, but does that situation that's with the bit farms put you off like going down another route if there was an acquisition there to be taken?
What I would say is the type of acquisitions that interest us are ones that bring more power into our
Mm.
portfolio. We're thinking about building out our power portfolio of pipeline all the time.
Yeah.
I would say that Riot communicates about our pipeline, our portfolio, pretty conservatively. When we talk about power that we have, that is power fully secured
Got the
in our
power. Yeah.
portfolio in operation. We don't talk
Yeah.
about things waiting for approval, things where there's uncertainty around. Um, our strategy, we feel like that's important for our credibility in the marketplace, is to just stick to what's fully approved, and then we work on projects in the background. And if they reach the point of certainty, then we fold them into our portfolio. I don't think you can expect us to be active in M&A relating to Bitcoin mining to the extent that there are power assets available. That's something that we are interested in, and that's something we'll always take a look at in order to build our pipeline. Because, as we progress here, as we, eventually build out for Corsicana and build out in Rockdale, we're going to have built something very valuable. We're going to have demonstrated a strong capability, and we don't want the story to end there. So it's on us to be taking these steps now early on to build this pipeline so the growth can continue even after those sites have been completed, which would create an enormous amount of value just in of themselves.
Now, one slide that really interests Bryce and myself yesterday, and we covered it on yesterday's podcast just before you came out with your earnings call, and it was a slide that highlighted the value of companies by megawatts of power. And I remember you brought up in the actual presentation to at the earnings presentation to say that that looking at what you're being given as a valuation at the moment, and you're quite right, you have got the 1.86 gigawatts of power there. It's not like it's something in the distance that you might have to do a lot more work to get it. It's being developed as we speak. And you're looking at the peer miners around you who've got these contracts now and seeing how their market capital's increased. Using Cypher and Iron as probably good examples of that. In terms of, at least Cypher has got a sort of a big co-lay cushion, and there's probably an expectation that Iron will go along the same route if they don't build out all the facilities with their own GPUs. But your expectations, obviously, once the deal comes along, you'll get the same sort of market re-rate that other mining companies have had since they've been signing co-location.
Yeah, we thought that chart was a useful lens for showing the value proposition of Riot. The peers to the left of us on that chart that have a higher valuation multiple on an EV per megawatt basis, they have higher multiple generally because they have signed deals. They've signed leases,
Yeah.
so the market is looking at their pipeline under that lens. So we believe the opportunity for Riot is as we are able to sign leases, the market will eventually be re-rating our capacity as well, and there's opportunity and uplift for the share price that comes from that re-rating. So we're excited about what we have, and we believe there's a great value creation opportunity that we have underway here, and it is on us to execute and demonstrate those results. And then, ultimately, we expect the market to recognize those results.
Yeah, perfect. Just before we come on to financing, one area that we never really touch on too much is Kentucky, and you've obviously got a mining site there. You purchased a company a couple of years ago, and I was fortunate to be at I think it was Nashville when you invited me to meet the team there. What's the likelihood for going forward for that particular site? Does it offer any opportunities in the future for potentially HPC, or does that remain a sort of like a mining site until mining stops?
The best way that we can maximize the value of our power is to ultimately build data centers. And Bitcoin mining, like we were talking about earlier, is a very valuable tool to spearhead new capacity and monetize capacity until that can happen. So our hope would be that eventually we could do that out in Kentucky. Those sites are obviously a lot different. There's multiple sites, they're smaller, they're in kind of, different areas. I think Corsicana and Rockdale are some of the
Yeah,
best data
massive,
center assets
massive.
on,
Yeah,
on the market today. But the goal would be to eventually, yes, make Kentucky a part of that story as well. And by the way, that's the same type of formula we would look to replicate wherever we can get power. And that improves the financial profile of any new project that we take on. That in that we can use Bitcoin mining to return capital until a data center can ultimately be ready and leased out. So I think Rockdale is an example of that strategy. Corsicana is an example of that strategy. And Kentucky is an example of that strategy as well. But that's probably farther down the pipeline.
yeah. Final question from me is obviously around the financing because we've heard so much now about what potential, the growth, what it's going to look like at Corsicana over the next 18 months. You're going to build these shells there. The phase one, you've got phase two coming online after that. Obviously, with the shell, there's probably not as much cost initially until you have a partner then to determine how you're going to fit out that shell. You indicated in the conversation, which was quite interesting to hear, about the level of cost per megawatt, and that was 11 to 13 is probably as high as I've seen it. I mean, we've got sort of 8 to 10 for TeraWulf and 9 to 11 for Cypher, and Core Scientific are doing some sort of like a hybrid solution, which is obviously a lot cheaper. But obviously, maybe that affects the sort of like the revenues coming through. What's your thought process going through the strategy and how you're going to fund this? What was the decision to go for like a really high end build?
Well, the first thing I think it's important to clear up. We cited 10 to 13 million per IT megawatt as about the industry average for builds right now. We expect to ultimately be in that range. That
Mhm.
cost is going to be driven by what the tenant is looking for. It's not us deciding to do some shiny bells and whistles thing or a more, a cost-effective build. The core and shells, well, core and shell plus what we're developing is what you need for any data center already. And then that ultimate tenant fit out, which is the most expensive portion,
That's it.
that's going to be driven by what that customer
Yeah,
wants. And then the lease rates are ultimately going to be a function of related to what that cost to build that is and what their specifications are. So, it's not us making a decision of, hey, we're going to build something really expensive or extra nice or whatever. It's simply going to come down to what is a tenant looking for, and we
requirement.
believe that
Yeah,
falls in the 10 to 13 million range.
yeah.
Now, on the financing strategy, so these corn shells, the cost is about 1.9 million per megawatt, IT megawatt that we laid out. Like we talked about earlier, our strategy is to go after high quality leases. We want to sign leases with very creditworthy counterparties. That is important because that will drive the financing options that we're able to get. And what we see with good leases, with good counterparties, you can get financing at about 80% loan to cost. What that means is, about 20% is coming from equity. And you can approximately think of the equity portion of these developments as these corn shells that we're building. It's not 100%, but
Yeah,
yeah,
yeah.
that's
I hear what
about
you're saying. Yeah, I
somewhere
hear what
around
you're saying. Yeah,
20% of what this project will
yeah.
be. Because Riot has such a strong balance sheet, we're able to kick these projects off. We're able to retain all of the economics to ourselves. We don't have an equity partner. We ended the quarter with about $400 million in cash on our balance sheet. This development is 214 million. And don't forget we have over $2 billion in Bitcoin that we've already demonstrated. We have some really useful tools to borrow against that to fund all the different initiatives that we have. We are in a great spot to kick off everything that we have, and that's what we're doing. And the next step after progressing on these corn shells would be to ultimately get to a lease and then take that lease and go out and get financing to complete the rest of the project.
And you feel dependent on the type of client that gets that lease that may give you opportunity for more levers to access and maybe a reduced cost of capital for shareholders?
Yeah, the higher credit worthy tenants that you have on these leases, the better financing terms you're going to get, and you're going to see that with better loan to costs that you're able to secure, and you're going to see that in the rates that you're able to get. With the strong counterparties, you can expect loan financing with a loan to cost of around 80 to 85%, and then you can expect tighter credit spreads to SOFR than what you would probably get with lower creditworthy tenants. So it all comes together to drive that ultimate economic result, and that's what we like to remind people. It's not just about one metric or one parameter of the deal. It's not just about what the rental rate is or this term or that term. You have to look at everything together because all combined, that's the ultimate, creates what the end value creation is for the company.
Looking at the two latest deals from Cypher and TeraWulf, they've had to give away a proportion of their company to Google, who have provided this backstop to Fluidstack in terms of ensuring the finances are all in place. Is that something that's sort of like an expectation now for miners who have yet to sign a co-location deal? Potentially, if they sign with a big partner, it may end up having to, to do something in a similar circumstance.
I think those announcements were very interesting and great for the industry because they showed more types of deals that were possible. And I give a lot of credit to the management teams for innovating these ideas and executing on them. So those are certainly those are possibilities that we have to pursue as well. And I'm sure as this industry matures, we'll see other types of deals come together as well.
Finally, one last thing on financing. You do have an element, I think I'm going to say 3,300 Bitcoin as a
3,300 approximately, yeah, is
yeah. Now that's leveraged against a 200 million loan.
correct.
How does that work in terms of the price of Bitcoin? Do you take Bitcoin back if the price rises, or you have to pay more if the price drops, or is it because it's significantly higher than the 200 million? That's the deal at the moment, and it stays at that amount.
Yeah, there are margin requirements to those facilities. So, the Bitcoin price drops considerably, then we would have to post
Yeah.
additional margin. Uh, Thankfully, the Bitcoin borrowing industry has matured. A few years ago, you'd have like 24 hours on the weekend to post additional collateral, and that's why we always stayed away from it in the past. The terms have improved considerably. We're seeing more competitive rates. We're seeing more borrow-friendly overall terms. And this is why we think this is a great tool for us to both retain the upside from Bitcoin while also being able to fund the financing needs that we have for our different data center developments. So we have a bunch of great tools at our disposal. We have our cash on our balance sheet. We have our Bitcoin balance, and we have access to capital markets. And we've seen other companies like Riot do a number of different deals. There's a lot of good tools out there. And what we're doing is we're making the best decision at the time on how to finance whatever initiative is underway based on the landscape at that moment. So we look at all these tools, we look at the options available to us, whether that's using cash on our balance sheet, of course, is always the natural first option. Whether it's borrowing against Bitcoin, getting some other type of equity linked financing, whatever. We have a whole bunch of options we can use, and we make a decision based on the circumstances and landscape at that time.
And with that large HODL you have, the remaining amount of the HODL, do you think the market's going to mature enough where those companies with significant HODLs can actually, there's more opportunity to maybe receive some sort of return for having that HODL, to utilize that HODL to drive a return?
You generate yield. You mean like
Yeah.
yeah. That is of course something we look at. That's an area where we are very conservative. Like I think we have done and will do just great simply holding Bitcoin and appreciating or getting the value of Bitcoin appreciating in price. I do hope the industry matures where there's options like that where we can be comfortable with the risk and grow our Bitcoin balance alongside that. That would be great. And we're seeing that in the Bitcoin back lending market, like we were just speaking on. That part of the market is maturing. Terms are
Yeah.
getting better, and hopefully, ultimately, there's additional opportunities from that as well.
Thanks, Jason.
Yeah, some great context there. You really can see the vision all coming together. You and I are fortunate, Anthony. We're going to be going down to Corsicana in about 2 weeks' time, seeing this vision in real life. Jason, we appreciate everything you're doing. Coming on the channel here today, giving us some insight into the business. I'll give you the opportunity to sign off, and congratulations on Q3.
Thank you. You were really proud of the quarter, and we're very excited to share more about what we have underway. We're trying to be very transparent about the process, share a lot of detail on what we're working on, and make clear what our milestones are and what we see tackling next to ultimately get to the winning outcome. And you can expect us to continue to be sharing updates as they progress. We're very excited about these additional developments. And just stay tuned as Riot executes on the strategy here.
Sounds like a
Thank you,
plan.
Jason.
Get the barbecue ready for us, and we'll see you in a couple weeks. Thanks so much,
Let's
Jason.
do it.